market is crashing, stocks are dropping, and I know it's stressful, but millionaires are made in the recession. Do you want to build your portfolio when stocks and ETFs are literally on a discount? Or do you want to be that guy who buys high and hoping to sell even higher? In this video, I'm going to share the exact combinations that I'm using right now to rebalance my portfolio during this market crash. If you're new to this channel, I'm Ericnomics. I share investing and wealth building strategies for free, so feel free to subscribe if you like free video tutorials, or follow me on Instagram if you prefer short form content. I'll explain step by step how I'm rebalancing my portfolio to stay safe and protect my money, the exact defensive ETFs I'm buying right now and why, and how to prepare yourself for when the market eventually recovers, because trust me, it always does. If you're ready to learn and take action, I'd appreciate if you drop a free like on this video. So, what's happening in the market right now? First, let's quickly address why the market is dropping. We've seen stocks soar for the past 2 years, especially tech stocks. They went up a lot, even in the crypto sector, and I'm sure you have that one friend who has made his first million investing in meme coin. Obviously, we don't have a straightforward market right now. Interest rates are still high, inflation is still above the 2% target, and economic growth is slowing. And we have the notorious Trump tariffs. Investors are nervous about what's the next tariff announcement because the Trump administration hasn't been clear with how long they're trying to impose these tariffs and what exactly are they trying to achieve for our economy. They say it's to equalize the trade deficit, but many believe that it's a bigger issue at play, leaving many people wondering if he's playing 4D chess or 1D checkers. Big funds are selling and many of us are feeling uncertain. But here's the good news. Market crashes are part of investing. They happen periodically and it's perfectly normal. And historically, they create some of the best opportunities to build wealth if you invest wisely and calmly. That's exactly why I've put together a defensive investment portfolio that's perfect for this market environment. So here's my plan on how I would allocate $30,000 right now. Just to note, this is adding onto my existing portfolio that is tech heavy. I'm not looking to add onto my existing tech holdings, but rather allocate more capital to these defensive investments. So at the very least, I'm still capturing the upside if tech does pop off. In this current environment that we're in, we don't know where the bottom is, especially since it's feeling like a falling knife recently. But we also know that investing during crashes is one of the most profitable things that we could do. So I would first allocate about a third of it into lump sum. That would be $10,000. Then I would dollar cost average buying weekly. I'm spreading it out evenly across 4 defensive ETFs, each ETF getting $2,500. And these ETFs are XLP, the Consumer Staples ETF, XLU, the Utilities ETF, XLV, the Healthcare ETF, and VNQ, a Real Estate ETF. Because these are the 4 main sectors that are most likely to hold up well even in recessions or market crashes. Why these 4 ETFs are essential for your portfolio during a bear market. First, XLP, the Consumer Staples ETF. Think of everyday essentials, groceries, household items, personal care. We all buy toothpaste, food, and cleaning supplies, even if the economy slows down, unless you're dirty, of course. XLP holds stocks like Procter & Gamble, Coca-Cola, and Walmart. These companies deliver steady profits even in recessions. Second, XLU, the Utilities ETF. Think about it. No matter what happens in an economy, we still need energy, gas, electricity, water. They're all essential. These big name utilities are reliable even during tough economic times. Third, XLV, the Healthcare ETF. Healthcare is recession proof. People don't stop needing medications or medical care just because the economy is slowing down. XLV includes companies like United Healthcare, Johnson & Johnson, and Pfizer. These stocks tend to be stable and provide consistent performances. Fourth, VNQ, the Real Estate ETF. Real estate, especially rental properties and commercial buildings, provide steady income. People always need a place to live or work. VNQ gives you exposure to real estate without actually buying property yourself. And it pays a solid dividend, which is extra income in your pocket. At the beginning of the year, global hedge funds dumped everything except real estate, according to Goldman Sachs. Here's a quote that sums it up best. Real estate often performs well in inflationary environments as property values and rents tends to rise with inflation. Now, here's the key. I'm not saying that these ETFs won't ever go down, but historically, they've performed better than other sectors during economic downturns. That makes them great additions if you're looking for stability and safety in your portfolio right now. If you understand my defensive portfolio so far, please do me a favor, drop a like so I know that you're following along. Now, some of you might be more experienced, but what if we want to be more aggressive and take on more risk to capitalize on market crashes? We could buy inverse ETFs that go up when the market crashes, but I'm not suggesting short selling. We're not shorting any stock over here. If and only if you're feeling confident and you want to take a more aggressive approach to profit off this market crash, let me show you a few options of inverse ETFs. Again, I need to emphasize, these strategies are riskier, so please proceed with caution and do thorough research before taking any action. Inverse ETFs moves in the opposite direction of the market. Think of it as stocks that go up when the market goes down. For example, if the S&P 500 falls by 2%, an inverse S&P 500 ETF would rise about 2% inversely. You could look at ETFs like SH, which inversely tracks the S&P 500, PSQ, which inversely tracks the NASDAQ. Be very careful with leveraged inverse ETFs. These multiply your returns and losses. Some inverse ETF shorts the underlying assets at 2 times or 3 times leverage. For example, the SQQQ is a triple leveraged inverse ETF. If the NASDAQ falls 1%, SQQQ would rise about 3%. And it could be 3% every time the NASDAQ increases by 1%. But remember, these are not designed for long-term buy and hold investments. They're designed for short-term trades only, and I mean short-term, like get in, get out same day, otherwise you'll experience something called decay. Simply put, you can lose value even if the underlying asset moves sideways. So that's why you don't want to hold it on for too long. If you're actively trading or managing your portfolio on a daily basis, you can consider put options. Buying a put option means that you're betting a specific stock or ETF will fall in price. Put options can act as insurance for your portfolio. For example, if you hold a lot of Tesla stock and worry that it'll drop further, you could buy a put option as protection. If Tesla's stock price drops significantly, your put options can gain value, offsetting some of those losses from your shares. And if you didn't know, put options are actually a very common investment tool that even Warren Buffett uses. It's a great tool to generate cash or to own a stock at a discounted price. I have a complete tutorial on how to generate active income while you're investing long term. So comment cash secured put and I'll send that video over to you. Options trading is complex and risky. You should fully understand how options work before diving in. So go ahead and get my free tutorial first. Finally, you can also consider trading the VIX ETF. VIX, or the fear index, measures how volatile the market is. When the market crashes or becomes chaotic, volatility spikes. So ETFs that tracks the VIX like UVXY or VXX will typically rise when the market volatility increases. But again, these are short-term tools and can be extremely volatile. Don't hold them for extended periods. Personally, I prefer a balanced approach, mainly using defensive ETFs and occasionally adding a small amount into these aggressive strategies from time to time. If you're interested in learning my exact investment strategies and real-time portfolio updates, you can consider joining my structured investment program. I guide our members to find the best stocks to buy at a discount and provide real-time option trade analysis to help investors generate stable income while investing. The link is in the description. In the end, remember to stay calm, avoid panic selling, and keep your portfolio balanced. If you found value in this video, please hit the like button and subscribe for more investing ideas. You could click this video over here to learn about my option strategies.